Welcome to Mental Models Daily, where we explore one mental model each day to help you elevate your daily decision-making. Today, we're examining a fundamental concept in economics: de-risking, a systematic approach to reducing uncertainty and volatility in economic decisions while maintaining potential for returns. De-risking is more than just avoiding risk. It's about optimizing the relationship between risk and reward through diversification, hedging, and strategic positioning. Think of it like being an investor who doesn't just avoid stormy seas, but learns to build better boats and navigate through various weather conditions. What makes this model particularly powerful is how it helps maintain upside potential while systematically reducing exposure to downside risks. A fascinating historical example comes from the medieval Venetian traders who developed one of the first systematic approaches to economic de-risking. Instead of sending a single large ship on a trading voyage, they developed the colleganza system, where multiple investors would spread their capital across several ships, each carrying diverse cargo to different ports. If a ship was lost, no single investor would be ruined. They also created early forms of maritime insurance and standardized contracts. This system transformed the highly risky business of maritime trade into a more sustainable economic model that helped build Venice's commercial empire. By de-risking through diversification and financial innovation, they were able to pursue profitable but dangerous trading routes while protecting individual merchants from catastrophic losses. In the modern business world, Unilever provides an illuminating example of economic de-risking in action. When facing increasing climate-related risks to their agricultural supply chain, they developed a comprehensive de-risking strategy that went beyond simple hedging. They invested in multiple growing regions for key ingredients, developed drought-resistant crop varieties with local farmers, and created alternative formulations for their products that could use different raw materials if primary ingredients became scarce or too expensive. They also established a sophisticated weather monitoring system to anticipate supply disruptions. This multi-layered approach to de-risking helped them maintain stable production costs while building more resilient supply chains. It's like creating an economic ecosystem that can thrive in various conditions rather than betting everything on perfect weather. So how can we apply de-risking in our daily lives? First, practice what I call strategic redundancy. Instead of pursuing maximum efficiency at the cost of fragility, build in backup systems and alternative pathways. This might mean having multiple income streams, maintaining emergency savings, or developing varied professional skills. It's like having both a furnace and a fireplace. You're paying more up front for peace of mind and protection against disruption. Second, implement gradual exposure scaling. Rather than making all or nothing decisions, scale your exposure to any new opportunity or risk gradually. This might mean dollar cost averaging into investments, starting a side business while keeping your day job, or testing new markets with minimal initial commitment. It's like walking into a cold pool step by step rather than diving in head first. Third, develop what I call correlation awareness. Learn to identify and reduce dependencies between your various economic decisions and investments. This might mean choosing uncorrelated assets for your portfolio, developing skills that are valuable in different economic conditions, or building relationships across diverse industries. It's like planting different crops that thrive in different weather conditions, ensuring you'll have some harvest, regardless of what nature brings. In conclusion, de-risking reminds us that successful economic decisions aren't about eliminating risk entirely, but about creating systems that can thrive despite uncertainty. By building redundancy, scaling gradually, and reducing correlations, we can pursue opportunities while maintaining stability. In a world of increasing economic volatility, this mental model helps us build more resilient financial futures. Thank you for joining me today on Mental Models Daily. Until next time, may your risks be calculated, your systems be resilient, and your returns be steady. For more mental models, please visit mentalmodelsdaily.com or find us on X or Instagram. Our podcast music was provided by thepodcasthost.com and Ali2, the podcast maker. Find your own free podcast music over at thepodcasthost.com/free music.